How to live off dividends and retire early. Do you absolutely know your dividends and do you want to live off of them? Well, I know you really want to retire early, but you always think of your dividends, right? Don't you worry, because I've got you. In this video, we'll go into detail on how you can live off of dividends and some examples for you to clear your mind on your questions about dividends. Let's get started. A secure retirement is typically the top objective for investors. The majority of people's assets are placed in accounts specifically for that use. However, after you retire, surviving off your investments can just be as difficult as putting aside money for a decent retirement. The majority of withdrawal strategies call for a mix of using bond interest income to pay expenses and selling shares to make up the difference. This fact is the foundation of the 4% rule in personal finance. The 4% guideline aims to maintain an account balance that will enable funds to last for many years, while also giving the retiree a continuous source of income. What if there was another way to increase your portfolio's annual return by at least 4% without selling any shares and lowering the principal? The purchase of dividend-paying stocks, mutual funds, and exchange-traded funds is one approach to increasing your retirement income. The cash flow produced by those dividend payments will eventually be able to replace your Social Security and pension income. It might even give you all the money you require to continue living the way you did before retiring. If you put some thought into it, it is possible to survive off of dividends. First, planning for retirement income can be challenging and uncertain. Second, an excellent strategy to stabilize retirement income is to add dividend income to the profits in your retirement account. Third, it's crucial to select the ideal mixture of dividend-paying stocks with dividend growth potential. Fourth, both retirees and investors shouldn't completely give up growth in favor of income. And fifth, a diversified portfolio of dividend growth and high dividend yield stocks can be created by small investors using ETFs, which are exchange-traded funds. An early retiree will be able to avoid using the capital in his or her investment portfolio and avoid the need to produce income by doing so with a strategy to retire at age 55 and live off the income from stock dividends. However, building up enough capital to produce income solely from dividends is particularly difficult at the moment due to the low yields on dividend-paying equities. Therefore, drastic cost of living reductions will probably be necessary for a 55-year-old to successfully plan their retirement. Consult a financial professional for assistance in developing a plan to retire at 55 and live off dividends. Funding retirement with dividends. People historically rely significantly on Social Security and interest from fixed income products like bonds when making retirement plans. However, 55 is 7 years prior to the earliest age at which most people can begin receiving Social Security benefits. Furthermore, fixed income securities aren't really helping right now because interest rates have hardly climbed above recent historical lows. For instance, the yield on 30-year Treasury bonds is currently slightly over 2%, despite the fact that inflation has been 3 times that amount. Equities provide the opportunity to generate larger overall returns. However, many retirement savers are wary about funding their retirement by taking principal withdrawals from their investments because the sharp market loss of the previous severe recession is still quite recent in memory. Being compelled to sell equities during a downturn can seriously damage a retirement plan's long-term viability, particularly in the early years of retirement. Stocks that generate dividends may be a superior third choice. Investors who keep their shares and just collect the dividends can weather price declines easier. Dividend yields are often higher than fixed income assets, and there is an unmistakable appeal to the thought of living off dividends while keeping the nest egg untouched. It's all about dividend growth. Unlike bond interest, the dividends on stocks typically increase with time. That is among the key justifications for why stocks ought to be included in every investor's portfolio. Additionally, historically, dividend growth has surpassed inflation. This knowledge can be leveraged by long-term investors to build a portfolio that is only for living off dividend income. Using those dividends to purchase additional shares of company stock is a wise course of action for those who are still saving for retirement. They will be able to acquire more shares and receive even more dividends as a result. Assume, for instance, that you invested $100,000 and purchased 1,000 shares of a stock that was trading at $100 a share. Due to the stock's 3% dividend yield, you got $3,000 in dividends over the course of the previous year, or $3 per share. Your total investment is $103,000 after you take the dividends and purchase more stock. Assume that while there is still little movement in the stock price, the dividend is growing by 6% annually. You will receive a dividend of roughly $3,275 in the second year at a dividend yield of 3.18% on $103,000. That represents a yield on cost, though, of around 3.28%. The yield on the cost of this dividend reinvestment plan keeps rising over time. The example portfolio described in the previous sentence would have generated about $7,108 in dividends after 10 years. Dividends totaling more than $24,289 per year will be yours after 20 years. Investing for dividends. Purchasing shares of the Dividend Aristocrats, a group of corporations, is one method of investing for dividends. These are substantial businesses with a long track record of rising dividend payments. The expectation is that these businesses will continue to pay dividends that increase at a rate that is as fast as or faster than inflation, even though previous performance does not guarantee future results. The average yield on Dividend Aristocrats has been greater than 3%, making them much more appealing than many fixed income securities. However, an exchange-traded fund that tracks the S&P 500 Dividend Aristocrats Index, for instance, is currently earning less than 2% from dividends as a result of the stock market's rapid price growth. Some dividend stocks offer significantly greater yields. High dividend yielding firms, however, are not always wise investments. Sometimes, high yields indicate that a company is having financial difficulties and may need to reduce its dividend. A $1 million investment yields $20,000 annually at a 2% interest. This is barely above the couple's federal poverty limit. A retired couple would require about $3.5 million in equities, earning a 2% dividend yield to earn dividends equal to roughly 4 times the $17,420 poverty level for 2 individuals. For the majority of people, starting to save and invest early will involve a great deal of self-control and sacrifice. You can use the Smart Asset Retirement Calculator to figure out how much you'll need to save based on your age and region. Estimating income needs. A feasible strategy for retiring will likely involve decreasing the need for income in retirement given these dividend returns. Most calculations place the required post-retirement income at roughly 70% of the pre-retirement income, depending on characteristics like wealth, health, life expectancy, and other variables. This might vary greatly. This is significant because it aims to maintain the same standard of living for retirees as they did while they were working. By being willing to tolerate a substantially less expensive lifestyle, a retirement planner who anticipates subsisting solely on dividends might increase the likelihood that the plan will succeed. To make a dividend-based retirement plan function, you can decide the upper limit on your post-retirement spending. To do that, multiply your anticipated retirement savings by 2%, which is the Dividend Aristocrats' current yield. Ways to cut retirement costs. Most households' largest expense is their home. Therefore, retirees frequently seek real estate as a place to save money. Retirees who downsize and relocate to a more affordable area can dramatically lower their housing costs. Paying off debts while still employed, such as mortgages and vehicle loans, is another strategy to cut expenses in retirement. Another area to investigate is healthcare. People often spend more on healthcare as they get older. A 65-year-old couple can anticipate spending $300,000 after taxes on healthcare bills in retirement, according to widely recognized Fidelity research, and that is when Medicare is in effect. Before the government health plan begins to provide coverage, a retiree 55 years old must find a method to pay for 10 years of medical care, so maintaining as much health as you can during retirement may be another method to cut costs. How much money you need to retire on dividends. To develop a sensible range for how much you need to invest to live off dividends, you can multiply the annual dividend income you desire to generate by 22 and 28 as a general rule of thumb. By multiplying these figures, one can obtain a portfolio dividend yield of between 3.5% and 4.5%, that is, annual dividend income divided by portfolio market value. Within that dividend yield range, we think it is possible to construct a conservative dividend portfolio without compromising on company quality, income security, or sector diversification. Over time, we anticipate this portfolio to produce mid-single-digit annual dividend increases as well. As an actual case in point, consider the U.S. According to the Bureau of Labor Statistics, elder households' total yearly expenses in 2014 averaged $49,279 per household. This amounts to nearly $62,000 in 2022 if inflation is taken into account. This household would require a portfolio between roughly $1.4 million or $62,000 times 22 and $1.8 million or $62,000 times 28 if dividends were their main source of income, assuming a starting dividend yield between 3.5% and 4.5%. The likelihood is that this couple has several sources of income, which lowers the number of dividends required for retirement. For instance, the Social Security Administration predicts that Social Security payments will make up the majority of the income for 2/3 of pensioners. The average monthly benefit for retired workers and their spouses in 2022 was around $2,500 or $30,000 yearly. The benefits alone may potentially reduce the size of the portfolio needed to allow this household to live off profits in half, even though some of this Social Security income would probably be taxed. The number of supplemental dividends required in retirement might be further decreased by pension income, annuities, and other income streams. Getting started with a dividend retirement portfolio. You can invest the money you set aside for a dividend investing strategy across several equities and mutual funds. Mutual funds and ETFs that pay dividends have low costs. Immediate diversification and ease of use. Most investments made with funds are set and forget ones. The majority of funds hold many stocks, dozens, hundreds, or even thousands. For instance, the High Dividend Yield ETF, VYM, from Vanguard, holds more than 400 firms. Some of these are respectable companies with secure dividends, while others are of inferior caliber and will see their dividends cut during the next recession. Some produce enormous yields, while others barely make any money at all. Simply defined, a fund is a collection of businesses that, especially when the market is down, may or may not be a good match for your individual income needs and risk tolerance. Due to its lack of a dividend safety focus, Vanguard's High Dividend Yield ETF ran into problems during the 2007 to 2009 financial crisis. It took the ETF 4 years to reach a new high after the 25% decline in dividend income during this time. Most funds also pay variable dividends, which move erratically over time, making it difficult to anticipate how much income you'll get each month. Even if these aren't strictly grounds to steer clear of funds, buying your own dividend stocks can help you better control the level of risk in your portfolio and gain more insight into your income source. Most businesses have quarterly or monthly fixed dividend payments. You will be fully aware of each stock's payment schedule and amount. In comparison to most funds, choosing your own holdings with an emphasis on dividend safety may result in higher and faster growing income. Additionally, you will have a better understanding of all of your holdings, giving you more confidence to weather the subsequent slump. The general rules to adhere when creating a portfolio are as follows. First, to limit company-specific risk, hold between 20 and 60 stocks. Second, given that it is difficult to predict which businesses will have the best long-term performance, give each position roughly equal weight. Third, no sector should account for more than 25% of your total investments. And fourth, choose businesses with safe or very safe dividend safety. What if you are already retired? If you have a long time horizon, compounding dividend income is tremendously advantageous. But what if you're getting close to retirement? For these investors, a dividend increase combined with a marginally higher yield can be sufficient. First, investors who are retired and want to live off of dividends may wish to increase their yield. In general, high-yielding equities and assets like preferred shares, REITs, real estate investment trusts, and master limited partnerships do not produce much in the way of distribution growth. However, if you invest in them, your portfolio's current yield will improve. That will contribute greatly to making it possible to pay today's bills without having to sell any securities. However, retired investors shouldn't steer clear of Procter & Gamble and other traditional dividend growth equities. These stocks will support income going forward by increasing dividend income at or above the rate of inflation. Investors who include these companies in their portfolios give up some present income in exchange for a higher payment in the future. Even while a small investor's portfolio might not be able to support them entirely, the rising and consistent payments nonetheless help to limit principal withdrawals. Dividend ETFs. Finding the ideal stocks for dividends can be challenging. Additionally, for small investors, attaining adequate diversification is even trickier. Thankfully, certain ETFs implement dividend strategies on your behalf. Dividend growth ETFs concentrate on stocks with promising dividend growth prospects. High dividend yield ETFs are a superior option if you're searching for immediate income. There is an alternative option to meet the crucial 4% requirement, despite the fact that the majority of portfolio withdrawal strategies entail mixing asset sales with bond interest income. Both young and mature investors can profit from the equity's compounding, historically inflation-beating distribution growth by purchasing high-quality dividend stocks with rising payouts. Investors may rely on their dividend payment streams if they do a little planning first. Retirees can avoid using the principal in their investment portfolios to cover expenses by starting to fund their retirement as early as age 55 with dividends. When equity prices fall, dividend-paying equities can help investors weather the storm by paying out greater dividends than fixed income returns. However, because dividend yields are currently low, relying solely on dividends to fund retirement would probably necessitate major reductions in the standard of living. So, did this video help you to further understand dividends? Why not share your thoughts in the comment section below? We'd love to hear from you. Also, check out more of our videos about your financial journey on this channel. Don't forget to click that subscribe button, ring that notification bell, hit that like, and share this video with your money and business-minded friends. Till next time.